Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Finance Minister tables the economic survey 3 days ahead of the union budget, pegs GDP growth in the range of 6.8 to 7.2% next fiscal. This is a slight moderation from the current projection of 7.4%. The survey says steady growth amidst global uncertainty requires caution but not pessimism. The rupee sinks to a fresh record low against the dollar. The economic survey says the rupee is punching below its weight, but adds it does not hurt to have an undervalued rupee to offset the impact of higher US tariffs on Indian exports. Not all import substitution is desirable, says the economic survey, argues for lowering the cost of capital to support industries instead of raising import duties. Economic survey calls for a progression from swadeshi to strategic reliance to strategic indispensability, bats for embedding India into the global systems to move the world from thinking about buying India to buying Indian without thinking. The economic survey recommends amending the definition of government company under the Companies Act, highlights that this would enable the government to cut stake in select public sector enterprises to below 51% without losing control. The survey says early evidence tempers extreme predictions on near-term job losses due to artificial intelligence, highlights a late mover advantage for India by adopting a bottoms-up, application-focused AI strategy. Cost of chips and constrained supply remains a bottleneck. Dalal Street gains for the third session. The Nifty reclaims 25,400 mid-caps. Banks and all major indices end in the green. The global uncertainty provides an opportunity for India, says Petroleum Minister Hardeep. Puri adds India has diversified sources of supply from 27 countries to 41 countries to limit uncertainty. That's an exclusive. Microsoft and Meta shrug fears of an AI bubble with strong quarterly earnings. Microsoft's capital spending jumps even as cloud revenue fails to meet estimates. Meta reports record quarterly revenue. Elon Musk Tesla reports first annual decline in sales even as Q4 earnings beat estimates. British Prime Minister Keir Starmer calls for a more sophisticated relationship with China after holding bilateral talks with Xi Jinping. This is the first visit by UK Prime Minister to Beijing in 8 years as Trump's tariff onslaught strains Western alliances. The Supreme Court stays new rules by the University Grants Commission on caste-based discrimination, says the rules have very sweeping consequences and will divide society and lead to very dangerous impact. Maharashtra's Deputy Chief Minister Ajit Pawar cremated with full state honours in Baramati day after his death in a tragic plane crash. Thousands gather to pay their last respects to the leader. Senior politicians across party lines attend the funeral. 3 days to go before the union budget. Finance Minister Nirmala Sitharaman tabled the economic survey in the Lok Sabha today. The survey has projected real GDP growth in the range of 6.8 to 7.2% for the next financial year. This is a slight moderation from the current projection of 7.4% growth. The survey says that steady growth, global uncertainty requires caution but not pessimism. On inflation, the survey says both the RBI and the IMF have projected an increase in headline inflation, but within the range of 4%, adding that FY27 inflation may be higher than FY26. The survey also makes a call for moving from swadeshi to strategic resilience for the next phase of industrial growth. It says India needs to increase its competitiveness and embed itself into the global value chain so that the world moves from thinking about buying Indian to buying Indian without thinking. The economic survey was tabled on a day when the rupee hit a fresh record low against the dollar. The survey said the rupee is punching below its weight by underperforming in 2025, adding that it does not hurt to have an undervalued rupee as it offsets the impact of higher American tariffs on Indian goods.
Currency depreciation that we are witnessing today isn't something unique to India. Countries which have a current account deficit have seen their currencies depreciate. If you look at the performance of currencies since the millennium began, the Indian rupee actually has done quite well. And the performance even since COVID, India is in the same ballpark, not an outlier. So we need to get the breathless headlines about the Indian rupee into perspective. The economic survey identified 23 areas where states could deregulate, simplify, eliminate, consolidate regulations. 23 into 36 gives you 828 areas collectively for states to look at. And the progress report is exceedingly good. probably A plus grade. 86% of these 828 priorities across 36 states and union territories put together have already been implemented or under implementation. Only 14% are not applicable. What Korea, Taiwan, Singapore, Japan did was to support their domestic industry, but in return, demand productivity and export performance and measuring up to global competition within a limited period of time. So protection cannot be in perpetuity, and it should be in return for productivity and export performance.
Well, that is the unequivocal message from the economic survey. Protection cannot be in perpetuity. Indian industry needs to become more competitive, and the Indian state needs to become more entrepreneurial. Now, the economic survey is calling for a progression from swadeshi to strategic resilience to strategic indispensability. The survey also argues for lowering the cost of capital to support industries instead of raising import duties. Abhimanyu is standing by with more on the fine print for what the survey says on this pivot. Abhi.
The Economic Survey 2026 has called for reasoned import substitution to cut imports and promote domestic manufacturing across India. It has called for a three-tier framework to promote indigenization across sectors, in which Tier 1 is going to comprise of products whose absence may cause an immediate distortion and immediate national costs, especially where global supply is concentrated. Now, Tier 1 will include critical defense systems, core infrastructure inputs, energy security components, public health essentials and foundational industrial technologies which are being used across the country. It has also indicated that Tier 2 is going to comprise of goods where local production is economically feasible, but imports are still persisting due to historical part dependence and early scale disadvantages which can possibly be removed to the advantage of local manufacturing. And the survey has indicated that indigenization in Tier 2 is being justified on economic grounds, with strategic benefits serving as a complementary benefit. Tier 3 includes goods where import dependence does not create any systemic distortion or any vulnerability across the value chain. Hence, import dependence can be continued in Tier 3. So it has clearly called for a reasoned path as far as import dependence and import substitution is concerned across several sectors in India.
All right, Abhimanyu, many thanks. The survey has also addressed concerns over AI's impact on jobs, saying that early evidence tempers the extreme predictions on near-term job losses. It's also explained how India, while has been a late mover, perhaps has an advantage when it comes to artificial intelligence. Ashmit joins us now with more on what the survey says about artificial intelligence and India's agenda for it. Ashmit.
Well, bear in mind that in the previous economic survey, the previous edition, we had seen big concerns being raised in the economic survey on what the implications could be on the job market as far as AI is concerned. Now we understand that some of those expectations that were there initially have been put to rest. At least what the economic survey cites is that early data that's coming in from countries like US, which are in advanced stages of AI deployment, is suggesting that perhaps those expectations were a little magnified. Those expectations have now been tempered, and that for a resource plus, for a talent resource plus economy like India, perhaps this comes in as a reassurance. That's as far as the labor front is concerned. On the architecture of this AI journey going forward, on that, what the economic survey calls out, that the models that the West has been following includes architecture that's very energy inefficient. It's hugely cash intensive, and that this is a model that in fact is not suitable for a country like India, and that India as a latecomer has that inherent advantage of having the benefit of hindsight. And then now India can perhaps go for a bottom-up approach wherein there is a concept of shared infrastructure, ensuring that there's more energy efficiency, and that is a model that India can now lead with going forward. As far as concerns are concerned, one aspect that the economic survey highlights that could perhaps play the role of a dampener has been the cost of GPUs, the chips, the AI-enabled chips, which will empower this journey going forward. That, the economic survey says, is entirely contingent on demand coming in externally. That's basically your Western countries. The demand that comes for GPUs elsewhere will significantly affect the cost of GPUs being available to India, availability of GPUs themselves to India, and that could act as a bottleneck going forward in India's AI ambitions.
All right, Ashmit, many thanks for joining us. That's the Economic Survey fine print. Remember, this has been a longer than usual economic survey, 700 pages, but a very comprehensive status check of where we find ourselves with the economy, the risks, the challenges, the opportunities, and the road ahead. We're now joined by Rajiv Memani, the president of CII. Rajiv, many thanks for joining us. The Economic Survey being presented in Parliament today. And as I was pointing out, the message that the Chief Economic Advisor is sending out seems very clear that protection cannot be in perpetuity. The Indian state needs to become much more entrepreneurial, and Indian industry needs to become much more competitive. What do you take away from the survey, and what hints do you pick up, if any, for the budget?
Thanks a lot, Shireen. I think no hints for the budget, because I think these are independent documents. But I think the key takeaways, I think, as you rightly said, it's a very comprehensive survey. I think it starts with highlighting India's macroeconomic performance, which has been very, very strong, and reflected in the improvement in the credit ratings, reflected in the GDP growth and everything else. I think the key concern that it brings out is the currency, and that's what it calls the paradox, which says that the strongest macroeconomic performance over the last decade, but you have a weaker currency because of current account deficit and because of FDI not probably being as high, or net FDI being lower than what we had thought. So really a lot of, at least the way I've read it, and one has quickly glanced through it and heard various comments, is that it really puts a lot of effort that for India to succeed, we have to rely a lot on the strength of the Indian economy. There are global geopolitical headwinds, and so one cannot in the headwinds of global geopolitical we need to really find a way that how do we do well as a country and as an economy, really strengthening, really relying a lot on the domestic strength. And for that, I think a much more entrepreneurial government, the focus that the government has done on reforms, I think needs to continue. And for private sector, especially the larger companies, to buckle up, and greater support to the MSMEs. So if I look at it, that's the manufacturing, and very clearly outlaying what it takes to be successful in manufacturing, whether it's reforms, whether it's ease of doing business, whether it's reducing factor cost of production, a lot on cost of capital, and what's happening. Center has been very good at that, but what's happening at the state level, how do you make states more efficient? I think that's been the focus. On your question on industry, my personal view is that there has been a lot of focus on industry from a competitiveness standpoint. I don't think that is an issue. I think industry has been very focused. I think the key challenge we have today is that we have one country that has been very successful, that has invested massively in manufacturing, in technology, and also has used various levers of state support to impact pricing and what normal pricing would be. And I think that's honestly, you factor that in with what Indian industry is looking at. I think that probably is if I have to look at it, that's the key dichotomy. And how does Indian industry move ahead in the face of that challenge? I think that is the key. And I think what the survey has outlined is something that I think the government is at, and I think it's something that we need to accelerate.
On the export front, the survey making it clear that India needs dollar earnings, and so India will need to export more. India's share of world trade is still under 2%. And while we may have had a new record as far as the exports are concerned in the previous year, we need to do more and we need to do better. Now, in that context, anything specific that you believe that the budget may highlight or bring in on Sunday to accelerate the pace of exports?
It's very hard to Shireen, to say what the budget may highlight or may not highlight. But I think one thing that this survey talks about, it distinguishes between services and manufacturing exports. And it says for the long-term success of the country, just services exports won't suffice. And the strength of the strength of the country will be reflected in the way our manufacturing exports grow. I think for the manufacturing exports to grow, my personal view is I think the reforms that we are looking at, whether it's on ease of doing business, whether it's reducing factor cost of production, whether it's something in terms of privatization of state electricity boards, to reduce power costs, to reduce the subsidies, what can be done for energy costs, power costs. I think that probably would be the key. I do think that there could be some customs duty rationalization to at least make maybe the raw material costs slightly lower to make manufacturing more competitive. And I think there are my personal view is this QC, rationalization of QCOs, looking at customs duty, looking at factor costs, really power and others. I think that probably those will be the areas where I also think that more if I look at just one, exports is one side, but they do talk a little bit about foreign direct investments. And how do we increase foreign direct investments in government companies? I think there maybe at least in terms of what public sector banks, if the FDI percentage is probably that may go up from 20% to 49% or 51%, something in that order. I think that probably could be something that one could also expect from the budget.
Well, will the FDI cap for public sector banks be raised? That's an important question and something that we have been discussing. Another idea that the Economic Survey has put on the table, of course, has to do with amending the definition of companies under the Companies Act for PSUs so that they can go down to 26% while retaining government control. Rajiv Memani, do you think that that's likely to fly?
I mean, I think... I honestly think right now also there's just so much of leeway to do even within the 51% category. There's so much of leeway to do divestment or privatization, whatever. I don't think we have fully leveraged that. Personally speaking, I think right now, given where where we are on divestment, maybe the government may first accelerate the process of divestment before we look at taking this down to 26%. Notwithstanding that, I think it's a great idea because you can today exercise control with 26%, with 35%, with 40%. A lot of the private sector that we see, exercises control with less than 51%. And maybe you can introduce the concept of golden share or something like that, which ensures that the decision making is controlled. So honestly, I think to answer Shireen, it's a great idea. I personally wouldn't be too optimistic that it will be passed. I think before that, if we can accelerate the divestment process, I think that would be better.
Yeah, I'm on your side. I'm in your camp. While it might sound like a great idea, I don't know whether it is a priority at this point in time. But let me come back to the rupee, Rajiv, because that is something that you spoke of, and that is something that the survey has spent a fair amount of time speaking. But let me ask you from industry's point of view. While the rupee depreciation, as the chief economic advisor also pointed out, is not new. We've seen a 4.5%, 5% depreciation annually for the rupee. But the pace of the fall, is that starting to concern industry?
I would say that, if you look at it at in a 5-year or 10-year basis, and that's what, when we engage with the foreign direct investors or private equity funds and FIs, I think that's what we say, that if you look at the last 5 years, 10 years average, it's not way out. But what has happened in the last 12 months, I think that is, it's a large number. I don't think that can be ignored. And, whilst we are comparing against the dollar, but dollar has been one of the weaker currencies globally. So if you were to compare this with euro and sterling pounds, I think that the fall is in the teens. So I think that is something that, there are two camps in industries. There is one camp which probably look more from a P&L standpoint, which is, it is in some ways for most companies, it opens up avenues for exports, creates greater markets in India from an import substitution standpoint. And to some extent, the tariff issues that we have had with US, I think it provides some relief against that. So I think to that extent, I don't think industry is that worried. Although the fall, any volatility which is very sharp, I think you cannot fully capture the benefit because you don't know which way it'll go. The second thing is from an investment standpoint, particularly those, from a foreign direct investment standpoint, from private equity, from those who are raising capital, I think it's a negative, because I think this is the question that people ask, that if we are looking at returns, it just raises your cost of capital. And as we said that, as they've articulated, one is the cost of capital is higher because the assumption is, whilst the center has done very well on the macroeconomic front, I think the state results are going down. And then you have a declining rupee because of current account deficit, which is not that significant, but it is still there. And this becomes a virtuous circus, because the FDI is not coming. So I think from an FDI standpoint, I think this is a concern. From people, from an FII standpoint, this will be a concern. So I think beyond a certain point, and I think we probably have reached that point, beyond a certain point, I think it becomes, it is not conducive, this kind of fall. So I do hope that, things stabilize from here on. The EU trade deal, and as and when that progresses, I think hopefully some of these things will balance out.
So Raji, very quickly, on the back of what you just said, as well as what the survey has said, do you then expect any intervention at this point in time, taxation-related intervention to try and alleviate some of these concerns, especially for FII and FDI?
I can't, honestly, it's difficult to comment on that, because this is not happening because of tax issues. Now, whether by reducing capital gains tax rate, things get better, you get a rush of FII money or FDI money, I don't know. But my personal view is 12.5% is a reasonably competitive rate. From a taxation standpoint, when you have more stability, when you have more predictability, when the controversies can be settled faster, when you have ease of judgment and ease of getting advance rulings, I think that is better. So I do hope that the budget focuses more on that than on the rate. There's been a recent judgment, as you know, Shireen, that's come, Supreme Court judgment. As long as the government makes it clear, whether through budget or otherwise, that this will only deal with issues from here on and not open pending issues, or, then I think that will also it has created some level of, I won't say panic is the right word, but people are trying to see whether, some cases will be reopened and stuff like that. So as long as they can settle that, I think that'll be more, that probably would be good.
Well, whether or not in her commentary, in her budget speech, the finance minister will choose to address that Supreme Court order, assuring investors that this is not going to be retrospective, that it will apply prospectively, as Rajiv Memani points out, could be an important signal to investors looking at India. Rajiv Memani, thanks very much for joining us here to take us through what you made of the economic survey. We will, of course, speak with you on our budget town hall as well as on budget day, but always a pleasure. Many thanks for joining us. The big earnings of the day. Quick commerce company Swiggy's net loss is above 1,000 crore rupees for the second quarter in a row. EBITDA loss has also widened to 780 crores on an annual basis. Revenue rose 54% to more than 6,100 crores, while gross order value for the food delivery business was up 20.5%. So the losses continue to mount there for Swiggy. Let's shift focus now to the defence sector. Defence stocks have rallied in the last week in anticipation of a higher outlay for the defence sector in the upcoming budget. Vivek is standing by with an analysis of India's defence production and what the sector is hoping for. Vivek.
As far as the production and indigenization details are concerned, India recorded its highest ever defence production of a little over 1.5 lakh crore in FY25, which was higher by 18% on a year-on-year basis. Defence PSUs as well as other PSUs accounted for approximately 77% of the total production, while the private sector contributed close to 23%. Now, coming to indigenous defence production, it hit a record 1.27 lakh crore in FY24, which was more than 2.7 times the figure it was in FY15. Now, talking about the share of domestic defence contracts in FY25, domestic industry contributed close to 92% of the total contracts. Now, at least 65% of the total defence equipment is manufactured domestically, a significant shift from the earlier 65 to 70% import dependency that India had. Now, talking about exports, remember now India is an export hub when it comes to defense equipment. India's defense exports reached a record 23,622 crore in FY25, and this number compares very favorably against just 1,000 crore just in 2014. India now exports defense equipment to over 100 nations, including to the United States, France, as well as Armenia. Now, talking about the government's stated ambition, the government aims to achieve defense manufacturing worth rupees 3 lakh crore and 50,000 crore in defense exports by 2029 and appears on track to achieve that. So it will be interesting to see what is the actual outlay that comes in the budget.
Actually, 20 to 25% looks very feasible in view of several developments in the geopolitics during last 2-3 years. Defense capital expenditure itself is likely to grow because many systems which were ordered previously last 2-3 years are going to mature. Apart from that, there is complementary and supplementary expenditure from other ministries. For example, the infrastructure facilities being set up by the space. That is the capex. In that, 20 to 25% is quite possible. And I'm also talking about the equipment, stores, etc.
20 to 25% growth in the defense capex. That is the former defense secretary, also our budget editor. On to CNBC-TV18 exclusive, Petroleum Minister Hardeep Puri says the global uncertainty provides an opportunity for India. Speaking with CNBC-TV18's Manisha Gupta, he said India has diversified sources of supply from 27 countries to 41 countries to limit uncertainties. Take a look.
We have diversified the sources of supply. From 27 countries, we are now buying from 41 countries.
Sure.
Availability, supply lines, they do get affected by uncertainty.
Right.
But because of the overall abundant supply potential and availability, despite cutbacks by OPEC Plus, which was 5 million barrels a cutback of some time ago and they're not fully restored,
Right.
prices haven't really shot up.
Well, that is Hardeep Singh Puri, the oil minister. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with plenty more.